Jenny heard on YouTube that the best way to get a raise is by switching employers. Following this advice, she switches employers every 6 months to a year. After about 5 years, her salary is now $120K a year. Her only debt is a student loan of $1,400 a month, and she stays with her parents to save on rent. But when she goes to apply for a loan, she's turned down. She'd built a solid credit history with a high credit score, maintained a low debt-to-income ratio, and makes a decent amount of money. She's also saved up for a 25% down payment, but only wants to put down 10. Why did the bank turn her down? The first possibility is that the house she wanted was just too expensive. But let's assume she could afford the home. What other reason would the bank have for turning her down? The answer is job history. Jenny jumps from employer to employer every 6 to 12 months. While it's been good for her paycheck, it shows a lack of stability from the lender's point of view. What if after getting a loan, she gets a new job in 6 months halfway across the country? Lenders generally like to see 3 years working in the same line of work and 2 years working with the same employer. That does not mean Jenny should not have switched jobs so often, but doing so is a double-edged sword. And that's okay because we all have different priorities at different phases in our life. Jenny's was increasing her earning potential for the last 5 years. As I said in another video, it's like an RPG character. It's impossible to max out on strength, speed, intelligence, and magic. It's usually a mix of being stronger in some areas and weaker in others. And those strengths can compensate for your weaknesses in others. In Jenny's case, she can either decide to stay put at the same company for the next 2 years, rising up through the ranks there, or she can put down a bigger down payment to compensate for the lack of her job history. Just understand that lenders look for evidence based on past behavior that you're not going to bounce when times get hard.